Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. For over a decade, investors navigated a world of near zero interest rates. But today's higher rate, more complex environment demands new thinking. In this episode, David Sherman of CrossingBridge Advisors joins us to discuss how to rethink ballast in portfolios, why liquidity risk may be the most underappreciated threat, and how to approach the market when set it and forget it no longer works. We'll then dive into an overlooked corner of global fixed income, the Nordic high yield markets, and explore why it might be one of the most compelling opportunities investors aren't talking about. David, welcome to the show.
Thank you for having me.
So let's step back a little and go to that decade-long 0% yield environment, which I think really conditioned a lot of investors at the time. And if you could just go into how did that kind of shape those investors' behaviors and portfolio exposures back then?
So this is pre-2022 when we had rates going down to zero. In Europe, they were negative rates. And investors really weren't being paid to have their cash be used as a store value of currency. So what happens when you're earning nothing or practically nothing, or in some cases negative returns? You feel forced to put your money into more speculative opportunities, things that have good fundamental business background, but may have higher valuations than historically you're prepared to pay, or companies that have really great growth stories, or investments that have a higher degree of risk of over a long period of time being successful. And you're pushing your money out, hoping that either yourself or the professionals you're using can discern the good from the bad. And generally, because rates on the short end were so low, you also pushed out your maturities, because typically, not something we've seen over the last couple of years, but typically short-term rates are lower than long-term rates because you're committing your money further out with more uncertainty. So they would also take longer maturity or duration or horizon risk. That's not a great condition. It's also a period of what they generally refer to as easy money, because if your cost of capital is very low, you have incentive to borrow, or if you're really lucky, issue stock at valuations that are based off of a low interest rate environment.
So summarizing, one portion is chasing yields, right? And chasing yields that just going further and further along the curve because you just have to get paid something. And another one is this easy money, which is maybe creating bubbles and potential bubbles. I don't want to say bubbles, but potential bubbles, and then just potentially higher valuations. And this just chasing method, kind of approach.
Definitely higher valuations. But the other thing you do get is sort of a venture financing or venture capitalist mindset. And if you'll recall, in those low interest rate periods, one of the asset classes that was garnering a lot of money and a lot of interest was venture capital, right? Because we're like, well, if I'm not getting paid very much, I can take more risk because my opportunity cost is low, because I'm not getting paid very much to lock up my money. So if I'm going to lock it up, I'm going to go for either long-term private equity with a lot more debt on it to try to soup up those returns, or I'm going to do direct lending, or I'm going to do venture financing. But you're looking for alternatives, generally things actually that have a lot less liquidity as another alternative. And since we're sitting here in September of 2025, right, between that period and where we are today, we had a period of inflation. We had a period of the easy money flowing through the system. So the Fed reacted by making tighter lending conditions, tighter liquidity conditions, thus raising interest rates, where 2022 was one of the worst periods for fixed income investors um, of the current modern period, because they raised rates and people had locked in low rates with longer maturities. And the Fed gave people plenty of warning they were going to do this. So it's a little surprising people sort of got caught, because if the Fed said they're going to do something, generally it's a good idea to listen to them. So taking that now to today, it looks like we may be headed back to low interest rates or potentially negative real rates. That's where your inflation rate exceeds the interest rate. So you're actually losing buying power or the ability to hold your value. Why do I say that? I say that because the executive branch of President Trump and the Secretary of Treasury, Bessent, are committed to reducing rates. One, because our government, U.S. government, is very addicted to borrowing money. So low rates helps make our budgets look a lot better. So if you have a credit card and your rate goes down, that's better than if your rate goes up, or if your mortgage payments are lower because rates are lower, that's better. They want to stimulate the economy. They want to lower the cost of money, and they're going to try to pack the Federal Reserve in 2026 with people that may have a little less independence and a little bit more political partisanship toward their desires. So the message today is not that much different than the message pre-22 with the Fed, which is, it is very clear the short-term rates are going down. The market has priced quite a bit of that in. The question is, how much will they go down? And what will the policies be to try to bring the intermediate part of the curve down if they can? I personally think it's a recipe for a yield steepening where short rates are artificially low and 10-year bonds and longer are adjusted at a natural rate, which is substantially higher than where we are today. But we'll see. I'm not an economist or a strategist.
Yeah, and I think one of the themes and one of the concepts it's not really a concept, one of the realities we have been speaking about, we put it out in our most recent market commentary, we had a podcast on, is the real rates. So real rates got to 2%. It's healthy for real rates to be positive. Just repeating it's the rate less inflation, the risk-free rate less inflation. You want it to be real, makes sense to be real. And I think we got as high as 2%. And now we're maybe closer to 1% on the 5-year. And that may easily come down if certain parties win. And it's, by the way, bad for investors and savers.
It's good for you,
But
because you have to figure out how to help them keep their buying power and not have their money retransferred because of negative rates.
Right. So let's go right into it. What's different about navigating today's market? We started, defining it a little bit. You brought up inflation as well. Inflation, the belief system pre-COVID was that inflation was never, ever going to come back again. It was done. Demographically, it was done. We could source anything cheaply through the world. Like, it just wasn't coming back. And then it came back and it was blamed on COVID. And now there's always another story coming around. So it'd be interesting to hear higher rate, slightly inverted, long end, like just a complicated, I'll just say a very complicated environment. So maybe if you could define the complicated environment and just talk about how that's different than where we were.
Right. And going back to earlier, which I didn't really bring up, but you make a good point, is there was a deflationary period where prices were declining and your buying power was getting stronger because prices were declining, that allowed rates to go negative and go low. Look, inflation is perceived to be better than deflation. So that's one of the reasons why they brought rates lower in those days too, because they wanted a little inflation. And my guess is, between COVID and the fact that they were trying to stimulate the economy for a little inflation, which is a little bit like a little being pregnant, you're a little pregnant, it set the stage. So, but where we are today, again, I'm not an economist. I've had a handful of economic courses. I'm not a strategist. We're bottom-up value investors. We apply our discipline at CrossingBridge Advisors using traditional value metrics that people know as Graham and Dodd, or modified Graham and Dodd if you want to move it out to Buffett kind of levels, or from my training at Liquidity when I was growing up, into credit, which we we focus on more speculative credit. So that means you're a hybrid between equity and debt. You have a combination of returns. But so my comments, we have to preface that I'm a practitioner, not an economist. But it's clear to me again that policy is going to force short rates down for good or for bad. That is the determination. There are things that may change that, including you need bond market vigils. But that's clear. Again, what's going to happen in the middle of the curve, 5, 7, 10 years, or even out to the 20 or 30, I have no idea. Right. Again, I think the market would say you should steepen it, but I've heard very smart people argue successfully that it could flatten with the right policy. But again, the purpose for this is they want to stimulate the housing market. They want to stimulate American first policy in manufacturing and delivering here. It could be successful. It could be like the golden age of the 50s. It could also be like the golden age of the period, what we call the Gilded Age, a little less friendly, or it can be unsuccessful. And I had a call this morning with a financial advisor of a turnkey asset management program. And they asked me my views. And I said, look, they said, when the world's overvalued. And I said, look, there are always pockets of opportunity that come with risk. There's no free lunch. But yes, stock market's high valuations in the US. Spreads for investment grade bonds are tight. Spreads on high yield bonds are tight. Basically, housing prices are high. Whenever you're looking around it, you don't say, there's a bargain out there. Everything looks like you have to work hard for it. And they said, well, what could cause it to fall apart? And I said, look, I don't know this. The backdrop is very different than 05 and 06, 2005 and 2006. But, things were expensive in 2005 in the first quarter, and then the second quarter, and then in the third quarter, and then in the fourth quarter. And then we moved into 2006. Ultimately, we had 2008. Things don't stay rich forever, but they can stay rich for a long time. And that's the paradox, which is, do I sacrifice participating with higher return on my money, or do I protect my downside and wait for my moment? Now, as a value practitioner, our view is there'll be an opportunity and that'll make up for a lot of patience. Now, to answer your question about, what it could do. So ultimately, there has to be an event. Money has to want to leave. And one of the things is there's a ton of money on the sidelines. We have some of the highest levels of cash sitting on the sidelines among wealthy people, or even middle-class people than we've had. And if that money moves, it's going to move into the market, which is just going to put more gas into the current market. If it doesn't move and they want to retreat, you'll start having things. So momentum is important, but also there's just a lot of money on the sidelines. The other thing is just huge technology advances that people are expecting. And this isn't just AI. This is medical, nanotechnology. This is ways of getting more power, electricity wise. These are all productivity gains potentially, or deflation, meaning lower pricing. So there's all those things. And generally tariffs are bad. I don't think there's a lot of debate over that academically. What typically happens with tariffs is they're stimulative in the beginning, and then they become bad. But we'll see what happens with tariffs. Tariffs could be the canary in the coal mine, or it could sort of pass away. But you could have a period like the internet bubble where we got productivity gains. It just took a long time, and people were disappointed at some point. So I don't know there's just too many moving pieces. To sort of figure out. And as a practitioner, who knew that tariffs could change your entire view on cost of goods margins? And if they're illegal, you're going to get that back, which is a huge windfall, which will just push the market even higher.
To be seen. Right.
And if you don't get it back, it's probably negative. So I don't really know. I describe this as a very, very difficult time to invest. At CrossingBridge Advisors, we are focused, I think, mainly on things where we think there's an event that could occur to unlock the value to reduce long-term risk or tail risk. And we're looking for things where they're higher quality. I don't think this is time to be in the distress market, the triple C market. And because people have been chasing returns, they're in the private credit market, which I think is less than meets the eye.
Yeah, no, the fair. And you threw a lot out there. I want to,
I'm sorry.
no, it's all good. It's interesting stuff. And I guess I want to emphasize one or two items, but then I want to drill down. I want to drill down a bit and narrow the scope a little bit.
I
So
hope I brought up enough I get invited back. That was the plan.
yeah, no, listen, maybe we could go long for him, right? We could, I think you have a 5:30 cutoff.
You'll
Go for 2 hours.
You'll lose your listeners.
Nah, never. No, it's a loyal group, um, loyal and growing. So one item I want to pull on is you mentioned, an expensive market, and that expensive market, some of it is it's just quantitative. It's just math. You just say, okay, the market's trading at a PE level of X, and that PE level is really high historically, and that PE level should correlate going back to yields because that's the way you calculate valuation. So conceptually, PE should be higher when yields are lower, risk-free yields, and vice versa, just because it's a plug, it's a component of how you do it. Yeah, go for it. Yeah.
So, as you know, I teach an MBA class at Stern, Global Value Investing. And the concept you just said, PE multiple, is very hard for these MBA students to actually explain what it really means. They know a high PE means asset growth rate, and you've got to have better earnings and a low, but they don't really, and I simply get to say two things. If you have a PE ratio of 20 and earnings don't go up or down, and let's just presume earnings represent cash, which we know may or may not be the case, it means you have 20-year payback. If it doesn't grow, it's going to take 20 years for you to get your money back. And the other thing we know is there's an earnings yield or a cap rate. That's a 5% cap rate. People know what cap rates are in real estate. So the 1 divided by the P is the earnings yield or the cap rate, where you can think of as the payback period in the PE. So obviously, if they're 30,
Right.
a lot of good things better happen, or you better have not much other opportunity to invest your money. And if they're 5, you might want to say, what's wrong with this company?
Yeah, no, that's exactly right. Right. And just even simplifying further, you go and you buy a company that's throwing off $100 a year. And you might say, well, if I'm positive it's going to keep on throwing $100 a year out, that's 10% if I pay $1,000 down. So I can make $10, right? And then if you expect it to go from 10 to or 100 to 110 to 120, 130, there's growth, you'd pay more. And then there's some future money. So getting $100 in 10 years is very different than in my pocket right now. And that's where the risk-free rate comes in. So that's the whole circle on PEs because I think that's right. And it's price over earnings. It's a simple calc, but it's really worth thinking about and then teaching to your constituents in school. Yeah.
Everybody thinks of the U.S. government bond as a risk-free rate. If I buy a 10-year U.S. Treasury, that's my risk-free rate. That's what we're taught in business school and in academia. It's kind of interesting because if you live in Zaire, maybe your government bond isn't the riskless rate.
That's right.
But I have a slightly different approach for your wealth advisors, your readers, and professionals. Whether you need a mortgage or you don't need a mortgage, you have to pay a mortgage back. So if you don't need a mortgage, you're just arbitraging, where you're borrowing an illiquid asset that's doesn't mark to market, that's tied up, and you're basically borrowing against that equity to invest in other things to make a spread, just like a bank. And if you need it, well, that's a whole different story. You need it. But at the end of the day, the way I look at this is whatever my mortgage rate is, that's my risk-free rate, because I got to pay it back. So this came up because a cousin of mine was a genetic scientist. He sold out of academia into commercial. They sold out successfully. He had stock options. He said, what do I do with my money? And I said, why don't you pay off your mortgage and then you can talk to me about it? And he said, oh, but it's locked up and it's tax-free. I said, well, why don't you pay it off? And then if you want to borrow against your house to invest in the stock market, we can have that conversation, right? Because it's a different mentality. So one of the things I do want to emphasize is in a period where developed world balance sheets, U.S. government, are getting worse, really bad, right? Big deficits. Whether they can default, not default, or whatever, maybe we should start thinking a little differently about risk-free rates and think about what is my personal cost to secure a primary residence mortgage rate.
Okay. Yeah, we're gonna that could be a part 2. Some other day we could get into that conversation. So just going back for a second, highlighting valuations a lot of times are rich. They've been rich for a long time, and the hard part of timing the market is that generally, and thankfully speaking, and it could change. That could also be in the part 2. It could change, but at this point, forward PEs are higher because earnings are increasing. Everything's increasing,
And they have been
and they have been increasing. And so you could have said, At some point in 08, 09, 2010, it was cheap. And then it became very expensive again pretty quick and stayed more or less over the last decade and change at reasonably expensive levels that we've been able to make up. When we don't feel like it can make up anymore, then you dive. And that's the problem with picking a spot and saying, bam, that's it.
Right. And Amazon's a great example. It lost money,
Yeah,
had negative earnings. So the multiple was infinite. Depends what your view on limit theory is, but infinite. But it earned its way out.
that's right.
And anyone who kept saying it's too expensive, it's too expensive, it's too expensive, like me,
They didn't do as well.
didn't participate.
That's right. That's right. So everybody out there,
But I'm not bitter.
right? The lesson is buy companies with negative art. No, I'm kidding. But I want to narrow the scope a little. So when, we started this episode speaking about a zero yield environment, and in a zero yield environment, in a zero yield, sorry, I have two different thoughts, but in a zero yield environment, when you are given the responsibility of managing and investing people's money, where fixed income is a component for, I'm going to say, two broad, very general reasons. Reason number one is to get some sort of return. You could say those are riskier fixed income. And reason number two is for ballast, right? And historically, what you really want is a real rate like today, where when you have ballast, and ballast is really a diversifier, protector, all these elements of basically having a well-balanced portfolio. Ballast is really hard in a 0% yield environment, or it could be.
Hard.
It's always hard, right? But it's hard for different reasons.
No, but whether it's 0% or it's a high percent, it's a relative cost, a relative return. Like, if everything
fair
prices
enough.
off of rates,
right?
But yes, in zero, if you make a mistake, the pain is significantly greater than in a higher rate.
That's correct. That's correct. And when you're sitting at zero, you're making different decisions, like just because, Japan's yield is negative, Europe's yield is negative, most of the developed world's yield is negative. Could America really go negative? America kept on claiming they would not go negative. And so then the question is, at that point in time, do I really believe that rates could decline further? What does it mean for, obviously, short-term rates? What does it mean for long-term rates? And the decision tree is maybe, at least in my view, a little bit easier than it is now. And then the other thing I'll throw in is that most people don't think about real rates. And so when they look at rates back then, it's like, holy cow, I'm getting 1 or 2% in my ballast condition. And right now it's maybe not this minute, but like a year ago, it's, I'm getting 5 to 6%, even though maybe that's really 2. And the other examples, it wasn't real rates. So it was minus a half, right? So maybe it's really a 2.5% spread as opposed to a 4 or 5% spread, but people feel more comfortable getting that 6 as compared to 2. So all those things, taken into consideration, I guess I'll go into, that was the ballast back then. We didn't answer the ballast back then, but I'm more interested in your views of where you think the ballast component is, right? We all agree. It's like, don't sit so easy with risk-free rates. Show up again for our part 2 when we talk about where not to sit easy on risk-free rates. But now in this environment, in this world, what are you looking at in terms of ballast?
Let's back it up and call it simple stupid.
Yeah, go for it.
Let's stretch and just assume people have net savings, meaning, they have more money than they spend in 1 year or 2 years or 3 years. It's a different conversation if that's not the case. So we're talking about people who have been savers, who have wealth. So, and where, it doesn't matter where they are in their spectrum of life, because if they're earning money, that just makes life easier. And if they're no longer earning money, then that makes life harder. They need more out of the portfolio. But there has to be some period, and everybody has their own level of how much risk they're willing to take and what their loss aversion is, how much pain they feel when they lose money. But generally, most cycles you can get through in 3 to 7 years, right? Going back to the Bible, we can say 7 years of famine,
going all the way back.
Yeah.
Why not?
3 years seems to be okay. Yeah. I use 5.
Okay.
Purely arbitrary, but that's what I use. But if you think about what happened in 02, you were fine. If you say, you sort of had 3 years. I mean, so the question is, let's think of two pockets of money. What do I need on a 5-year basis to meet my expenses or my lifestyle or my needs? And it's a rolling 5 year. So if it's a year from now, you still got to do 5 years. So every rolling 5 years, what do I need? And then after 5 years, I can invest much longer term and feel more comfortable, regardless of zero rates, high values, low values, that I have time to earn it out, right? I have time to go through that volatility feature. Now, in periods where you think the market's overvalued or you're not as comfortable taking risk today, you could overweight what you need for the 5 years. Say, I'm taking some out of that long term and I'm intentionally going to keep it in the safe bucket. Or you could say, I think the market's really cheap. I'm going to take it out of my safe bucket and move it. But if you think of it in two buckets, that helps. And I think fixed income, it should be in the first bucket. And yes, you could argue it could go in the second bucket, but it only goes in the second bucket if you want to speculate that interest rates are going to go down. But if you say I'm agnostic to interest rates, I don't know if they're going up or down, that longer bucket is hard to have a lot of fixed income, right? Because obviously if rates are 5%, they go to -1, you have a 30-year bond, you're going to make a lot of money. But that's an interest rate speculation.
That's right.
And in that long-term 5 year, you have all kinds of things. You could buy into a business. You could do private equity. You could do direct lending. You could do venture capital. You could do stocks, whatever you feel comfortable with. But fixed income is most appropriate for that first 5 year bucket. And quite frankly, if you're saying, well, this is to make me survive, well, year one should be cash and cash like securities, ultra short duration, cash like, right? Anything 6 months or less should just be cash on the market or CDs, but things like that. Anything that is 6 months to, let's say, 2 years, ultra short duration, meaning a duration or a maturity of sort of average of 1 or less, right? You could overweight them, but that's what they should mean. Then when you get to year two, every rolling 2 years, you say, well, 2 to 5, I can take low duration, meaning it has an expected time horizon of 2 to 4 years before it rolls into cash. And it doesn't matter whether it's liquid or illiquid. It matters in the sense you can get your money if it's liquid, you can sell it, but it doesn't matter in the sense that you're now thinking about matching horizon, holding horizon. The advantage about liquidity, meaning mark to market, is if you overweight that short end and the market takes a dive, you can say, all right, I took a hit on my short end, but I took such a little hit. I can sell it at a little loss to go buy all these things that were really, really cheap on the longer duration focus or longer term horizon. So that's how I think about it. So in that period, once you get to that thought process, I think about time weighting, and then you think about risk. And the question is, what is the asset class generating today? Are you compensated for that risk? And do you like the product or the manager you're doing? So I'll take a compare and contrast. We think the Nordic high yield market is extremely attractive relative to all other high yield markets in Europe and the United States. Why? Because first of all, you're getting more spread, you're getting more return in the securities period. They tend to be short term, 3 to 5 years. They tend to be floating, which is a negative if you believe rates are going down, because you're going to reinvest lower as the rate declines. However, they're call protected. So whatever spread you're buying, so if it's SOFR or EIBOR or STIBOR or NIBOR, that's the base rate you're reinvesting lower. But that spread that you're getting on top of it, that's a long duration asset for the maturity. If it's big, you're call protected. You get to lock that in longer, and you get call premiums, meaning they have to pay you a premium to take you out on your financing. So unlike your mortgage where you just go to the bank and say, I pay it off, here they may not be able to pay it off, or after they can pay it off, they may have to pay a premium, and they also have to give you a notice, just like in the United States. Okay, so great, more yield, but what about the risk? Well, they're better credit qualities. They're generally on an open exchange, so they get more transparency. They generally have less leverage. So if the US bank market is, call it 4 times debt divided by what they would call cash flow, using EBITDA, I would not call that cash flow, but let's say, or double Bs or single Bs, Here you're getting companies that typically, instead of being at 4 to 6, are at 2 to 4. So a substantial discount to the amount of leverage these underlying businesses have. And you're getting more yield. Oh, and you're getting covenants. Covenants are contractual protections. So in the old days, in the 90s, when you, what they call leverage loans, they were bank debt, syndicated, publicly traded bank debt. You had these rules that said, well, you can't put more debt on top of me, debt incurrence, or you have to maintain a certain amount of cash flow to service your debt, or you can't sell your assets without paying me down. But as securitized products came in and the demand for leveraged loans increased, but there was not enough good quality product, a guy said, there's a yield I got to make. So I'll keep that yield, but I'll give up my contractual protections. Well, it's like a wealthy person getting married out of true love and saying, I'll skip the prenup, right? It works a lot of the time. But when it doesn't, it's really ugly. And then you get credit on credit warfare we have today. So they have covenants. So I have better protection, more yield. I generally am secured, by the way. So I have better security interest. I have equal transparency, and they're short maturity. So now you, and they're less levered. So now you say, yeah, but they're in YIBOR, they're in Euro, um, Swiss kroner, Norwegian krone, pound, and there are some in US dollar, by the way.
Are these all European companies, or
Yes.
they're US and European?
When I say Nordic market,
Right,
these
right.
are investment bankers
That they
working really hard to issue paper out of the Nordic framework.
okay.
But Forum Energy is a US company. It issued paper out the Nordics. There's a Jones Shipping Company, I can't remember the name right now, it'll come back to me, issuing debt out the Nordics. Carlyle, KKR, Sun Capital, Investcorp have all issued portfolio companies out of the Nordics.
And are they doing it there because of liquidity profile? Like why are they using the Nordic exchange?
So they're using the Nordic platform because the only alternative for most of these deals, because they're small deals,
Okay.
is direct lending. Because
Got you.
so let's back
So
up.
smaller,
The bank market doesn't lend. Banks don't lend anymore.
That's right.
So you can say, well, I want to bring a deal to the US or to the Europe. Well, unless it's 500 million, they're not interested. It's got to be 500 million, $1 billion, $1.5 billion, $2 billion. You're a guy who wants to borrow 150 million or 100 million. Where are you going? So your choice is direct lending, or you go and become an established issuer, and the Nordics will do, their deals are typically between 50 million US dollars to 500 million to 400 million US dollars. And they're syndicated. So it's more like small to medium sized loans, but of decent companies. If you go into Bloomie's and you see a Jorg Jensen phase and go up in the 100, Jorg Jensen issued out of the Nordics. There's a hassle.
Got you. Okay. Really interesting area of value. So, I know
if you think the dollar is going to devalue, you don't hedge out the currency.
Right.
But you can hedge out the currency.
Right. Do you are you guys hedging some currencies, or?
We are. Our clients are dollar investors.
I got you. So you are.
So
okay.
We're not going to speculate on the currency by making a big currency allocation. Is it a perfect hedge? No. It's not.
I got you.
There's a little slippage, but by and large, we're doing 1, 2, and 3 month swaps, currency swaps.
Got you. Okay. No, that's fair. And it makes a lot of sense, because otherwise, right, you could lose and win, right? You win on the investment, but lose on the currency. It could be quite big. Okay. So talk to me a little bit about, I believe one of the risks that you see or you think folks aren't focused enough on is a liquidity risk.
For sure.
Define it and tell us why.
Okay. So with all the financial academic work that's been done, there's a limited amount of work that has parsed out a component of your return for liquidity, right? So if somebody says, I want to borrow money for 10 years, right? Typically you look at where the 10-year government bond is. Typically it's higher than the 1 year. You say, well, because I'm going out 10 years, I need to get paid more. That's to put my money out. Okay, that's maturity risk. That's tying it up, but it's not really a liquidity risk. Liquidity risk is you want your money, you want it now. And are you being paid enough for investments that aren't liquid? So spiders, the S&P 500, super liquid. You don't need a big liquidity risk. You can buy an ETF, you can get in and out, the bid-ask spreads are low, there's a volume. You might not like the price, it might decline on you, but you can get out pretty much with no problem. Now let's go to the other extreme, private equity. By definition, you can't get out, right? There's a contractual term that says, I'm taking your money and I'm going to invest it, and then I have a reinvestment period. And then I can hold it for a harvest period. Oh, and by the way, in a lot of cases, I don't know what the definition is. They say, oh, we didn't get good prices for this security, so we'll sell it to a continuity fund. You could take a big discount, or you could roll your money to extend your lockup even more. So venture capital has less liquidity. If you invested in X or XAI or anything or SpaceX, you invest in SpaceX, how are you getting your money back? There are secondary markets. They're very inefficient. Now, if Robinhood gets their tokenization, or WisdomTree gets their tokenization, they do tokenization, it will take an illiquid asset and effectively create liquidity for them. But the question is, what's that spread? So typically, academic studies say if you can buy a 5-year treasury, or you can buy a 5-year 3-month treasury, or a 4-year 9-month treasury, one's on the run, the 5 years on the run, the other what they call off the run. And that spread differential is your liquidity risk, right? Because it doesn't trade as actively. Some say liquidity risk is bid-ask spread. What are you paying? What are you selling? What's that spread? I think those are all measurements of return you should make in regards to the ability to transact, execution risk. But liquidity risk is really when I want to get out, how the hell am I getting out? And what happens when markets melt down, you can't get out at a decent price. So as you have more volatility or you have a declining market, your liquidity risk grows. Your ability to transact, to convert to cash becomes harder. But in periods like this, where people are chasing product and spreads are tight and market's rich, you're not people like willing to give up liquidity risk, the future growth of risk, because they want to put their money to work. So one of the ways we measure liquidity risk, not really perfect, is if you have a CD at the bank, it's generally guaranteed by the U.S. government, depending on size, but let's go there. They have what they call brokered CDs, or you can go to the bank and buy a CD. Well, they have a little rule that says if you want your money back, we'll give it to you. Great, but you don't get any interest, or you get a
penalty. Yeah.
Well, okay, so what they're saying is you actually have perfect liquidity, but there's a penalty. Well, you can measure that. But then you can take it one step further and you can say, okay, well, what are the CD rates minus a treasury that has an active liquid market, and sort of look at that spread and see if you're being paid enough. But in general, as you go down quality, where you take more risk, where you take areas for more return, people don't account for the lack of liquidity. It's a risk they don't really think about. So if I take HYG, which is the ETF for high yield, I mean, quite frankly, what happens when people rush into the product? It trades at a slight premium. But when people want their money, it trades at a discount.
Yeah.
And they just assume it's fine. But people aren't pricing liquidity risk enough. And I think today, no one's thinking that they need enough premium for liquidity risk, because liquidity is not likely to get a lot better than it is today. It's likely to stay where it is or get worse over time, not better.
Yeah. No, listen, I think it's a great point. And you have a lot of Wall Street wizardry, which goes and creates products, and sometimes it takes a little bit of time to kind of get up the kinks. One example is, frankly, where ETFs are going today, which is what's the next stage of access? What's the next stage of access? What's the next stage of access? And they are starting to play around, in my opinion, in areas of the credit market where historically it's been very illiquid, which we'll say by appointment, wide bid-ask spread where it's getting tighter because there's all this activity from these ETFs. But then when something occurs, that liquidity will just completely disappear overnight. And something that happened in the '08 financial crisis was that there were significant discounts to the net asset value of ETFs, liquid throughout the day, high volume ETFs for some period of time, just because there's an interplay when a client purchases it, someone else is selling it, and then they have to purchase it, and it's just the professionals are going to be fine. Retail will be less fine. So I think that's.
Is this like the broker's yachts, but where are the customers?
Say that one more time.
It's just like the old joke. These are the broker's yachts. Where are the customers?
Yeah, there you go. There you go. Exactly right. But listen, I think it's a really important point that you're bringing up on liquidity. Overall, the appreciation of liquidity, the reasons to effectively price and really think through what is the risk profile here and what should I get paid for it? Because by the way, you could decide, all right, like again, liquidity, the easiest way to look at it is I give you $100. I could go to your house at any point in time and take my $100 back versus I give you $100 and you have to give it to me in 5 years. There's just a difference of what I demand from you.
Look, you can,
right?
I can give you two, I'll come back to DTS, but people have been very excited about private lending, private credit.
Yeah.
I don't understand why any of them need to be a private fund. Let's ignore that they get performance fees and management fees that probably are extremely too high for the outcome they're going to produce and the money they're lending out. If they lend out at 12 and they're 2 and 20, you're not getting a great return, even if they employ some leverage. I don't know why they have to be private funds. Every single one of them could be a target mutual fund or target closed-end fund. The way that works is it says, okay, I'm going to do a 10-year private credit fund. It's a closed-end fund. In 2035, it will liquidate. And for the first 5 years, we'll put the money to work and we'll reinvest.
Yeah.
And in the back 5 years, we'll harvest. So the first 5 years, your dividends will represent income. The last 5 years, some of it will clearly be return on capital. And it's a great way of doing it. And by the way, if they do a really good job, it's going to trade at NAV or higher than NAV because the dividend yield will be really good. And if they do a poor job, it's going to trade at a discount. So the underlying portfolio will dictate how well it trades. But if you think about it, private funds have to go back in the market and recreate new funds anyway. It's really a good way of providing transparency and creating liquidity in an asset class that doesn't need to be illiquid. There are things that should be illiquid. I mean, you can't do a private
That's right.
equity fund so easily in a public vehicle. You could do a closed-end fund, but you can't do it in like a daily liquidity fund unless the underlying product is gated. So the concept with ETFs was similar, right? Well, we can deliver securities rather than price, and that solves some of the liquidity risk for less liquid. But market makers don't want illiquid securities.
That's
So
right.
it doesn't really work. And as mutual funds start creating share classes that are ETFs, which will be happening, look, it's simple. You can just do cash create and cash redeem. And an ETF that has a cash create and a cash redemption is a mutual fund.
That's right. That's right. They're all the same. So let's close out the show with this. This last component felt like a PSA, like a public service announcement. So with that in mind, with the PSA in mind, just give one or two tips of just on that, staying on that liquidity term of, what to look out for or how to think about it.
So I think liquidity cuts both ways. I think people can over hoard liquidity and cash, and as a result, underinvest and lose out. But I think a lot of people barbell. They hold too much on the front end, meaning 5 year or less needs. And the long end, they don't think about liquidity. And I think it's better to think about what do I really need for a certain time period when I'm going to tie up money, but I have freedom. So I'm happy to have freedom for 5 years and tie up money less. I think rearranging your thought process will help you think about the liquidity risk you're taking. And then you say, well, if I'm tying my money in that more than 5 year bucket or 7 year bucket or 3 year bucket, then I'm tying it up. Am I being paid enough to put my money out that long? And that in itself will start solving, are you being paid enough for liquidity risk? And on the front end, I definitely, you want to have liquidity. So do I have liquidity? That's the question. If you don't, it doesn't end up in that bucket. And that would be my PSA announcement.
Awesome. David, thank you so much for coming on the show today.
Thank you for having me.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.